the investing world is witnessing the end of an era. Charlie Munger, the witty and insightful partner of Warren Buffett, has passed away. Buffett, the Oracle of Omaha, has finally stepped down from his role leading Berkshire Hathaway. Their departure marks a profound shift, not just for Berkshire, but for the very nature of investing itself. For decades, they were the gold standard, their names synonymous with value investing and extraordinary returns. Together, they built Berkshire Hathaway from a struggling textile company into a sprawling conglomerate. Their investments became the stuff of legend, their shareholder letters eagerly anticipated for their wisdom and wit. Buffett and Munger became icons, their principles of patience, discipline, and long-term thinking resonating with investors both large and small. The rise of quantitative investing, fueled by complex algorithms and massive datasets, is challenging the traditional, human-driven approach that Buffett and Munger embodied. The question now is whether the principles they championed, careful research, long-term thinking, and a focus on intrinsic value can survive in an era increasingly dominated by machines. The investing world will undoubtedly miss their presence, their pronouncements, their annual pilgrimage to Omaha. The challenge now is to learn from their example, to adapt their timeless wisdom to a rapidly changing world, and to ensure that the values they embodied continue to guide investors for generations to come. Warren Buffett, born in Omaha, Nebraska, displayed an early aptitude for business and investing. He was a precocious entrepreneur, selling chewing gum and delivering newspapers in his youth. By his early teens, he had already purchased his first shares of stock and even filed his first tax return. Charlie Munger, with a background in mathematics and meteorology, took a more circuitous route to investing. After serving in World War II, he attended Harvard Law School, where he developed a keen interest in business and finance. Their paths crossed in 1959 at a dinner party in Omaha. Despite their different backgrounds, they shared a common ground, a deep passion for business, a voracious appetite for reading, and an unwavering commitment to rational decision-making. Buffett, already making a name for himself with his investment partnership, recognized a kindred spirit in Munger. Munger, in turn, was impressed by Buffett's investment acumen and his simple yet profound investment philosophy. Munger, with his sharp intellect and wide-ranging interests, pushed Buffett to look beyond the numbers, to consider the broader context of an industry, the competitive landscape, and the quality of the people running a business. Their partnership, forged in mutual respect and a shared intellectual curiosity, would go on to redefine the world of investing. Their partnership found its ultimate expression in Berkshire Hathaway. Originally a struggling textile company, Berkshire Hathaway became the vehicle through which Buffett and Munger would showcase their investment prowess. Recognizing that the textile industry was in decline, they began to use Berkshire's capital to acquire other businesses. They targeted companies with strong fundamentals, a durable competitive advantage, and honest and competent management. Under their leadership, Berkshire Hathaway transformed from a single industry company into a sprawling conglomerate with holdings in a wide range of industries. They acquired businesses like Geico Insurance, See's Candies, and Dairy Queen, companies that were leaders in their respective industries and generated strong cash flows. They also took large stakes in publicly traded companies like Coca-Cola, American Express, and Gillette, companies with iconic brands, strong management teams, and a history of generating consistent profits. Buffett and Munger's investment approach was characterized by patience, discipline, and a long-term perspective. They were not afraid to be contrarian, often buying companies that were out of favor with Wall Street. This long-term focus, combined with their disciplined approach to capital allocation, allowed them to generate extraordinary returns for Berkshire Hathaway shareholders. Central to Buffett and Munger's success was their adherence to a value investing philosophy. This approach, popularized by Benjamin Graham, emphasizes investing in companies that are trading below their intrinsic value. Buffett, a student of Graham at Columbia Business School, embraced this philosophy early in his career. Munger, however, brought a nuanced perspective. He argued that while buying cheap companies was important, it was equally critical to consider the quality of the business, the strength of its management team, and its long-term prospects. This emphasis on quality, combined with their focus on intrinsic value, became the hallmark of the Buffett-Munger approach. They were willing to pay a fair price for a great business, recognizing that a high-quality company with a durable competitive advantage could compound its earnings over time, generating superior returns for investors. Munger's influence on Buffett's investment philosophy extended beyond the realm of individual stock selection. Munger was a voracious reader with a deep understanding of history, psychology, and a wide range of academic disciplines. He introduced Buffett to the concept of mental models, simplified representations of how the world works. Their partnership was a testament to the power of intellectual collaboration.